Good afternoon, everybody. Welcome to our next webinar in the 12B Green Energy Fund. Today, it's my pleasure to have Mansoor Parker, a senior tax executive at ENS. Welcome, Mansoor. Thank you for taking the time out today to share your wisdom with us.
Thanks a lot, Jeff.
It's always a pleasure to have you as one of our participants on our Grovest webinars.
Thank you.
Just a little bit of housekeeping. There will be CPD points for those who are looking to get CPD points. Please stay on the line till the end of the webinar, which will be probably around about an hour. And if you can just send an email to Jenna at grovest.co.za, Jenna, Jenna, and tell her that you want your CPD points. She will obviously send you the certificate in the next day or so. We will be having some polls. There will be 1 or 2 polls taking place during the course of the webinar, so please feel free to answer them. The more people that participate, the better the result, and we can get a better feel of what's going on. Also, that there is a chat. Please send any questions you want to myself or Mansoor during the course of the webinar, and we'll make every endeavor to answer them to the best of our ability. My ability is not as good as Mansoor, so a lot of them I will direct in his direction. So without any ado, I'm going to, we're going to kick off today's session, and it's really all about 12B and 12BA, provisional tax season coming up upon us. How can we use 12B or 12BA to minimize our provisional tax payment? And we're going to go through everything that there is to understand really about the 12B and 12BA allowance, and as well as provisional tax and how that will affect us. So, Mansoor, thank you again for joining us. Tell us in simple words, for those who are joining us for the first time, who haven't really got a feel yet for the 12B or 12BA allowance, what it's all about.
Thank you, Jeff. I picked up a very slight echo. Are you hearing me okay? Is this fine?
Perfect. I'm hearing you perfectly.
Okay. 12B is a section in the Income Tax Act, and it contains a number of subsections. There's 12B1H, which is actually the section that we are focused on, because other types of bioethanol and other things are dealt with in other parts of 12B. But the relevant section that we are looking at is 12B1H, which deals with the renewable energy projects. And the purpose of 12B is really to stimulate investment into those types of assets by providing what's referred to in the Income Tax Act as a capital allowance. You note for tax purposes, a distinction is normally made between CapEx and OpEx, that we have operational expenditure, you incur the expense, salaries, wages, rental payments, you deduct the costs immediately. When you get to capital expenditure, you don't have that same treatment generally. And then the capital allowance rules come in to dictate that over what period of time you're allowed to deduct the cost of those capital equipment. And 12B is an example of an accelerated capital allowance provision, sometimes referred to as enhanced provision, where you're allowed to deduct the cost of those renewable energy assets over a shorter period of time. Now, we've always had 12B, and 12BA is a relatively recent introduction and will be in place for a short period of time. Both will be in place at the same time, and they have slightly different provisions. So under 12B, your typical rule would be that you buy the renewable energy asset, and the cost which you pay, let's assume it's 100, you claim that cost as a reduction over 3 years, 50% of the cost in year 1, 30% in year 2, and 20% in year 3, unless you're dealing with certain types of projects, such as a PV solar plant of less than 1 megawatt, then you get the full 100% deduction in the year that the cost is incurred. So obviously, being a tax provision, it's got lots of requirements, conditions, exceptions, limitations. I won't go through all of them. 12BA enhances that deduction. So it allows one to claim that deduction in 1 year and up to 125%. So it provides a really good deduction, but it also tightens up certain of the requirements. For instance, unlike 12B, which had no new and unused requirements. So under 12B, you could buy an existing project from someone else. And then where that person sells the project, they simply claim a recoupment of their previously claimed deductions. And then you bring it into use for the first time. And then you then claim the 12B from that point onwards. 12BA, on the other hand, has a new and unused requirement, which means that the asset must be new and unused. So it is possible to have a portfolio that comprises both 12B and 12BA projects, but there are differences in the approach between the two sections. So I think the sections work very well to stimulate investment into these sectors, and we've seen of late with all the partnership funds being established, including yours, the growth of a local tax equity market. Something that's been quite popular in the US with all the incentives that they give for these types of projects, and I think it's really promising to see the growth of this market in South Africa.
Oh, well, that's great. Now, I think what we need to also understand is that 12BA is only available for 2 years.
Yes.
Am I right in saying it's from the 1st of March 23 to 28th of February 25? So that would be assets brought into use for the first time and generating energy during this period.
That's correct, and it is a limited exemption, and it's a pity. One would have hoped for a longer period of time, simply because earlier with the bigger projects will recognize it takes some time. If one is project financing a renewable energy project, you've got to first start with the licensing process, getting consents and approvals, negotiating with the landlord, getting the equity and the debt funders in place, getting to financial close, and then the construction phase, and then thereafter you get the commercial operation phase, which is normally coincides with the brought into use requirement. So because this section came in with effect from 1 March 2023, which has already passed and will expire in 2025, it places a challenge on larger projects to fit within this time frame. But small and medium-sized projects, they shouldn't have it. They should find it easier, at least, than the larger ones to start within this period. So the 2-year time frame is very important to know, as well as the brought into use requirement. That it's not simply the case that if I spend the money to acquire the renewable energy asset, I can claim the deduction. No, there's an additional requirement. That asset must first be brought into use in order for the deduction to be claimed. And
go ahead, Mansoor. Carry on.
Yeah, Jeff, sorry, were you going to ask something?
No, please carry on.
It must first be brought into use. And the question of brought into use is a factual question. And sometimes we do get asked that in certain cases, before it's brought into use, there's a commissioning phase, and it's someone might want to test that all the assets are working properly before it's handed over and then brought into use. I don't think that any sort of testing to see that it's in working condition, and even if there's some electricity passing through, would qualify as bringing it into use. I think such a testing phase is purely to ensure that the assets are working properly. I think when it's brought into use, it means that it's generating. And as you said earlier, there's an off-taker, there's a customer who's buying the output from that renewable energy asset, and that would be the bringing into use phase. So that is the year in which the investor is allowed to claim the deduction, whether under 12B or 12BA. The brought into use requirement exists under both sections, except that in 12B, there's a limited window. It must be brought into use in that 2-year window. So if it's brought into use outside of a 2-year window, it simply means that you then fall into 12B, and your deduction may either be 100% over 1 year or 100% over 3 years, 50, 30, 20. You don't lose. You're just in a slightly different a time frame for claiming that deduction.
Okay, so but I think what's important that investors into a fund into a particular tax year would ideally want to match their investment and with the tax benefits. So I think it's important that when choosing a fund, that there is a close understanding that the investment during that tax year will be brought in, or they will be invested into assets which will generate electricity and be brought into use before the tax year end.
Absolutely, to have the contribution match the deployment of that cash and the bringing into use, not just deployment. Yeah, absolutely.
So that gives us a good atmosphere background of the 12B for the moment. Tell us about provisional tax. What is provisional tax? Just give us the broad understanding of what provisional tax is.
The provisional tax, first of all, is not a separate tax from income tax. It's purely a method of paying an income tax liability in advance. The purpose, as articulated by SARS in their guidance documents, is to ensure that the taxpayer doesn't have a very large tax debt on assessment. So provisional tax achieves that by allowing the tax liability to be spread over the relevant tax year. And it does so by requiring the taxpayer to pay 2 amounts in advance during the tax year, and a third optional payment at the end of the tax year, but before SARS issues the assessment. And those 2 payments would occur within 6 months from the start of the tax year, and then 6 months thereafter on the last day of the tax year, with the voluntary additional top-up payment being made later. By the time the provisional, the income tax return is submitted with the calculation, one will then set off the provisional tax payments against the tax liability in the income tax return. And in that way, it achieves that goal of allowing taxpayers to settle the income tax liability in advance.
So who would typically be a provisional taxpayer?
There's a broad category of persons. Typically, those are persons who derive, let's say they derive remuneration from an employer who is not registered for employees tax, and it happens more frequently than we think. Diplomatic missions, embassies, etc. They typically have persons who are on their payroll, but the actual diplomatic mission itself or the embassy is not registered for employees tax. So persons who receive their remuneration, they won't be provisional taxpayers. They may still be liable to submit income tax returns, but they might be able to fall out of the provisional tax net. It will also be persons who receive amounts that do not constitute remuneration. So if, say, I'm a salaried person at ENS, but if I have on the side various other forms of income, such as rental income, that can push me into the provisional taxpayer box, requiring me to register as a provisional taxpayer, even though I'm receiving the bulk of my income through remuneration. So the receipt of remuneration is not sufficient on its own to take one out the provisional tax box. One needs to look at what other forms of income does one get, and whether that triggers a provisional tax liability. Companies are also provisional taxpayers, as well as persons who the Commissioner for SARS may identify by way of a notice that they are provisional taxpayers. So we have this group of persons other than companies, which could include trusts, natural persons, persons who are companies are provisional taxpayers, persons who are notified that they are provisional taxpayers that also fall within that net.
So who would not be a provisional taxpayer?
We've seen some interesting applications of this issue. They would include tax-exempt organizations. They're typically not provisional taxpayers. And for those in the audience who are part of or involved in tax-exempt organizations, what we've seen of late is some of the larger tax-exempt organizations, such as PBOs, they would incubate a new business within the actual PBO. And once it grows to a certain size, they then hive it off into a new company. And for as long as that business is within a PBO, for instance, that business does not pay provisional tax. It would pay tax on assessment, which provides it with a very good cash flow, some excellent liquidity, because instead of having to make 6 monthly payments, it then makes payments on assessment instead. In addition to that category of tax-exempt persons, you also have, say, natural persons who do not derive income from the carrying of a business. And there one needs to consider the particular circumstances of that natural person to decide whether they meet the threshold to be a provisional taxpayer or not.
Okay, brilliant. Now, provisional tax is it sounds complicated. You have a first provisional tax, you have a second provisional tax, you have a top-up tax. What are the different timings and how is provisional tax calculated?
So earlier on, I mentioned the two payments. So let's just deal with those two payments a little bit more specificity. The first payment, let's assume we're dealing with a natural person. Investor is a natural person, and for all of us, we have the same tax year. It starts on 1 March, and it ends the last day of February of the following year. And I learned to use those terms in drafting contracts because, as we know, certain years, February has 29 days, other days 28. Yeah. So I would never describe Feb as the 28th day or the 29th. They say the last day of February each year. So that is our tax. That is our tax year. So for provisional tax purposes, the first provisional tax payment is made 6 months from the start of that tax year. So that means that for a tax year that starts on 1 March and ends on 28 Feb, The first period for which provisional tax becomes due will be the period ending on 31 August. Within the March and February dates, and that first payment is made on or before the last business day of that period. The second period for which provisional tax becomes due is the period ending on the last day of the year of assessment. So that would make it either 28 or 29 February, on which that payment is to be made. On both dates, looking at the first period, the taxpayer must make an estimate of his or her taxable income for that year. So the taxpayer estimates the taxable income for the full year and then pays half the estimated liability for tax by August. When that taxpayer gets to the end of Feb, the taxpayer does an estimate of the taxable income for that full year, and then pays the tax, but then deducts the August provisional tax from the total amount. So it's forward-looking assessments to look at how much income one is likely to get in the particular period. Except for the second period, you have had the benefit. You might have made a payment for the first period, so you take that into account when calculating the tax to be paid in the second period. The third period is a period that occurs, a voluntary top-up payment period. So that's just meant to sort of mop up any income that you might not have taken into account when doing your second period. Then you do a third payment in the subsequent year.
Great. So, okay, before we go on, let's have if you don't mind, if we can put on the first poll just to get some sort of idea of who our audience are. Are you a financial or wealth advisor? Are you a potential investor? So we can just get, or individual, so we then can, get some sort of idea who we're talking to before we go into how the 12B investment can affect your provisional tax. Okay, can we put the results on the screen, please? Okay, I haven't seen anything. Okay, so we'll carry on. We'll carry on and see where we get to there. Right. So now, Mansoor, how can investors use an investment into, let's say, the Green Energy Fund, the 12B Green Energy Fund run by Grovest, to reduce their provisional tax payment? Is it possible?
Yes, it is possible. And let's deal with the first period, given that we are in August and the first provisional tax payment will be made at the end of August. So at the end of August, let's say you fall in the provisional tax box, and now we are required to submit a provisional tax return to SARS, and that provisional tax return will include an estimate of the total taxable income, which will be derived by the taxpayer in the year of assessment. The calculation is based on the estimated taxable income, and the estimated taxable income is sorry, I was just seeing the images flash up on the screen. The taxable income is our gross income less our exempt income less all amounts allowed to be deducted. Now, the 12BA or 12B allowance will fall within that category of less all amounts allowed to be deducted. So let's say I'm the investor and I've contacted you, Jeff, and you've said that we're making good progress on this project. We have a reasonable level of assurance it's going to be brought into use before the 28th of February next year. So I sit with whoever is assisting me with my provisional tax returns, and I say, I think I should claim this deduction. I've paid the amount over. I've got the proof of payment. So if SARS asks me for that, I'll be able to give it. I've spoken to Jeff. He said everything seems to be on track with this project. It's going to be going live, going active before the end of Feb. I think I've satisfied the brought into use requirement. So when I calculate my provisional tax for the end of August, I will then take that into account in calculating my taxable income. In other words, I'll look at my gross income and I will claim the deduction for that amount. Because at this stage, we're estimating our income for the year. It doesn't have to be a certain amount, but it's an estimate of the amount that we think we would pay. Now, where things could start getting slightly tricky is we have been paying provisional tax for multiple years. SARS would typically include what's referred to as a basic amount in my provisional tax return and say, based on your prior assessment, you were assessed for this amount of taxable income, then using that as a yardstick for how much I should be paying this year. But last year, I did not make a contribution to a 12B or 12BA fund. This year, I am. So therefore, my estimate for this year may very well be less than what I've paid in a previous year. So what one could expect is that, yes, you would say that I'm fully entitled to calculate my estimate, my provisional tax estimate, taking into account the fact that I've made this contribution. But you should also expect that if the amount is less than what I paid in the previous year, that SARS might query it. And they might say, well, we would like you, a taxpayer, to justify the estimate that you've made, and then to furnish particulars of that estimate of the income or expenditure, or any other particulars. And that's where the documentary requirements would be very, very useful, because from a payment point of view, they'd want, show us proof that you made the payment. So we'll pull out the bank statements, send the proof of payment, ask you to provide confirmation you've received it. And then there'll be the second requirement, has been brought into use. And this is where an assurance given by you that the project is on track would put the particular investor taxpayer into the position to say, I can claim this deduction in my August because I've checked it out. I've done a serious, it hasn't just been based on corridor talk that it might be ready. I've got actual documents to show that the project will be brought into use before the end of Feb. And therefore, when I do my August provisional tax return, I can claim that deduction.
So let's just unpack that a little bit. So investor, now a taxpayer, he's earning 2 million rand a year, and his taxable income's 2 million rand, let's say net of any deductions, and now he has to pay his provisional tax. He has to pay 50% of that, so he's got to pay 1 million, or let's say 45% of 1 million rand. Of 2 million rand, so he has to pay 900,000 rand provisional tax. So now he now needs to pay 50% of that, which is 450,000 rand in cash, that he now needs to pay across to the receiver of revenue by the end of August. Now he then decides that he doesn't want to pay that 450,000 rand as the first provisional payment. He would rather take and make an investment in the Grovest 12B Green Energy Fund, and say he would invest effectively 450 divided by 125%. So which would be, just to give you exactly, give you my maths, I'm just looking for my calculator here. So it's 450,000 divided by 125. So he would make an investment of 360,000 rand into the Green Energy Fund. And that way, when calculating his provisional tax, you would say, I'm investing 360,000 rand. He'll get assurance from Grovest. We're making 2 queries that money will be invested into projects that will be energy generating by the end of the year. You would then take his 360 times 125%, which is 450,000 rand. He would deduct that from his taxable income, whatever, and he would not have to make that payment. Is that correct?
Yeah. It was a very quick back of the matchbox calculation that you did there, Jeff. The principles are correct. Obviously, the taxpayers just have to check and see what the amount is that they need to put in. But yes, the approach is a correct one. They would make a contribution, and then take that contribution into account. 125% of that contribution in calculating the provisional tax for the August period. And the nice thing with the August provisional tax payment is that SARS has a system of understatement penalties where they can penalize taxpayers for understating income if they felt that the understatement was not the result of a good bona fide error, or they just weren't serious enough in calculating the amounts. There is no understatement penalty for the first provisional tax payment. The understatement penalty only applies for the second provisional tax payment, the one in February, and that's written into the Income Tax Act. So which reduces the risk on the first provisional tax payment. What exists on the first provisional tax payment is a late payment penalty. And the circumstance where I could see a late payment penalty arising is if the taxpayer does the calculation and says, I don't believe any provisional tax is due, and completes a null return and sends it off to SARS. SARS says, well, according to our records, our information, we think an amount is due for August. And that SARS then says, we wish to increase the provisional tax amount for August up to that amount. By the time the taxpayer would pay that amount in terms of the SARS assessment, it would be late. That payment would be made after August, and SARS will slap on 10% penalty. Now, that will only happen if there is a source of income which the taxpayer hasn't fully taken into account, or there's a deduction which the taxpayer choose to use but wasn't entitled to use in calculating August. In your case, however, there is an existing project. There's an actual contribution to the fund, and there is a date for the asset to be brought into use. So for SARS to deny the taxpayer the ability to take that into account, I think it'd be very difficult in the circumstances, because I think the taxpayer would have the paperwork lined up to defend such a claim by SARS.
Correct. So when, just for interest sake, just when an investor makes an investment into the Grovest 12B Green Energy Fund, they receive a transaction note, and that transaction note would actually be proof of the investment. Of course, they also receive a signed copy of the deed of adherence, which is to the partnership agreement, and so they could obviously have the documentation that they have made the necessary payment. But is there any, what happens if SARS challenges, or disputes the investor deduction?
I think such a challenge is probably more likely to be around the time of the second provisional tax payment than the first. Well, if we look generally at what happens, SARS will say to the taxpayer, you need to provide justification for the estimate that you have done. The taxpayer will then send it into SARS, will attach the paperwork and send it into SARS through e-filing. So let's say that SARS takes the decision that they're not happy with the submission made by the taxpayer, then it is possible to take that SARS decision on internal review within SARS. It's not possible to object or appeal to that. So there are different dispute resolution processes within SARS. And there I would suggest that the taxpayer just to someone who's aware of how to litigate tax matters with SARS, a tax controversy specialist, so they can advise on the proper avenue. But the reason why I started off by saying it, I think it's more likely under the second provisional tax payment, is that the second provisional tax payment is made towards the end of February. So by that time, one should really know whether the project has been brought into use. By August, we can say, well, we still got 6 months to get to that point. So therefore, the assurance should be sufficient. But by the time we get to Feb, at that point, one should know either the project has been brought into use or it hasn't been brought into use. And it's a question of fact, really. There is the brought into use terminology it's used in several parts of the Income Tax Act. And it's basically a facts and circumstances test. Sometimes these facts and circumstances tests, they can be difficult to apply because they require judgment calls to be made. But they can also be flexible. So it allows one to consider a number of relevant factors in a particular matter. So I would say that the likelihood of SARS being able to successfully challenge a reduced August payment, provisional tax payment, is low compared to February, because by February they simply ask, has the project been brought into use? And then if the answer to that is yes, then you're entitled to claim the reduction when calculating your provisional tax. If the answer to that is no, they say, well, then you should have paid the tax without taking this into account.
Now, quite interesting, just how we have structured our partnership is that every month a new micro partnership is created. And though that micro partnership gets allocated or invests into assets that are then deployed or into a particular project. So, you know, the way we've structured it is the earlier that you get into the partnership, into the 12B Green Energy Fund, the quicker your allocated assets, which can then be brought into use. So if you only invested in February, and those assets for whatever reason didn't come into use, you would not get your, but those who invested maybe in December into those assets, and those assets have become into use, those they would then get the deduction. So all I can suggest is to those parties or investors or taxpayers who are looking to invest into and take advantage of the 12B or 12BA tax deduction, the quicker that they invest into the fund, the more, let's say, secure they are of matching the investments with production in the same year.
And if that matching doesn't occur in year one, then the matching will occur in year two. So it's not a case of a deduction being lost. It's simply a case of in which year do you claim the deduction. Because like you said, if you go in early enough, it's matched with a project which has been brought into use. If you invest later and then it's matched with the project in tax year two, then the deduction is claimed in tax year two.
Correct. Again, I've been just reminded that there is CBD points being allocated to the session. Please feel free to just email Jenna at Jenna, Jenna, at grovest.co.za, and tell her to send her your certificate, and she will duly do that. So Jenna at grovest.co.za. Okay, we have a couple of questions. Mansoor, I'm going to go through the questions that we've got. Some of them we've covered. But so here's from Mr. Lesetla. How does this, inverted commas, brought into use work in relation to an asset that is part of an organization's ongoing investment in renewable energy? So grid-tied PV for own use. This energy is not sold to a third party, but for oneself. Can one claim the 12B or 12BA allowance?
And that's a very interesting question, Jeff, because the way it's worded is, and I mean, to give a proper answer to that, one would require somewhat of a technical reference to particular provisions of 12B and 12BA. And what I'd always learned doing tax is never trust tax advice when it's given from memory. Always trust it when it's referring to an actual section. So and the wording in the section refers to brought into use for the first time for the purpose of the 12B language is for the purpose of his or her trade, and then to be used by the taxpayer in the generation of electricity. So that wording is wide enough to cover a situation where my trade might not be the generation of electricity. I could be a manufacturer, but I have a trade. I'm manufacturing various items which I'm then selling, and for the purpose of that trade, I'm investing in renewable energy assets, which I'm then, because I need stability of power supply. The load shedding is creating issues for my trade. Bringing these assets on. I don't see an issue with it. Now, in that case, I don't have a power purchase agreement. I'm not taking the electricity and selling it to a third party. It's purely for self-use, that I'm buying the assets, I'm putting them on my roof, if it's solar, of my factory or my manufacturing warehouse. And then I'm using that to supplement the electricity which I'm getting in from the grid. And it's quite clear that I'm using it for the purpose of my trade, except that my trade is not the generation of electricity. My trade is one of manufacturing. The wording in the section has been brought into use for the first time by that taxpayer. And is it for the purpose of his or her trade? And is it going to be used by the taxpayer in the generation of electricity from certain types of power? So when I look at the wording relating to generation of electricity, that wording appears to refer not to the nature of the trade, that the trade should be the generation of electricity, but that word, generation of electricity, is referring to the nature of the projects that will qualify. So it says wind power, concentrated solar energy, PV solar energy, a hydropower, a biomass. So it looks like those words, generation of electricity, is referring to the types of electricity generation projects, the types of renewable electricity generation projects that will qualify for the reduction. It's not referring to the actual trade carried on by the taxpayer. The section simply says, is it used for the purpose of the trade? And I think the reason why they put that wording in is to differentiate between that which is used for the purpose of a trade, and where I put panels onto my roof, which is for domestic or private purposes. It's not for the purpose of a trade. So if I put in the inverter, the batteries, and the solar panels onto my roof, I can't claim the 12B deduction for that purpose, because I'm using it for the purposes for domestic or private purposes. Whereas an entity which is using it for the purpose of his or her trade, they are able to claim the 12B deduction. So I think it works in the situation sketched by the set out in the question.
Thank you. So we got another question: will this session be recorded? Yes, it is going to be recorded, and it will be available on the Grovest YouTube channel. Then we have a question here that the partnership structure on e-filing, when you prepare your tax return, and they ask, how do you record? It's on your tax return, how do you record your investment into the partnership? They say, do they ask whether I'm a partnership, and if so, must I say yes?
Okay, within the tax world, we've got the big split between the advisory world and the compliance world. That in the advisory world, we advise on future transactions. In the compliance world, they report past transactions to SARS. And that question fits squarely within the compliance world. I sit squarely within the tax advisory world. So my gut feel is that yes, we would, but obviously just understand, I don't regularly file the returns with SARS. So you need to check it out with someone. But my gut feel response would be, yes, if it prompts you on whether you're a member of a partnership, you've got to tick yes. And there will be some form of drop-down box. It will probably ask you to identify the nature of the partnership. It might even ask you to supply, it won't be financial statements, because a partnership is a tax transparent entity. It's not an entity in its own right. It's a flow-through vehicle, but just some sort of indication of that partnership. I think from a SARS point of view, they'd want to check to see how income is being reported by different partners into SARS. So I'm not sure what the drop-down box will say after you tick yes, and what further information it will ask from you. But I would say, if you partner in a partnership and your tax return requires you to answer that question, then you should answer that question yes, and then deal with the questions contained in the drop-down box that flows from that initial response.
So what we do in our fund, or at the end of the tax year, we will give a tax certificate to all investors, and that tax certificate would include the amount obviously invested into the fund, confirmation that that amount has been invested into projects that are generating electricity, It would also give you the amount of distributions that you are entitled to receive or have received during the current tax year. And included in those distributions, we will carve out the amount of interest that the investor may have earned in that distribution, because there is an interest, let's say a tax-free amount that you can claim, so that you can take advantage of that. And that would be given for the lifetime of the fund. So distributions would be taxable in the hands of the investor. It's not a company, so it's not a dividend. It's actually a distribution of your share of profits and or of interest into the partnership. Okay, then we have a question here. So what is the maximum amount one can invest to get the tax incentive? And unlike 12J, which was had a cap for individuals and trusts at 2.5 million, here, and companies 5 million, there is, Mr. Jones, there is no a cap. You can invest as much as you want into the partnership, subject to the partnership being able to accept that amount of money that they would be comfortable to deploy in the current tax year. So if you came with a 200 million rand check, the partnership might say, listen, we can't take all 200 because we can only deploy 150, but there is no cap on the amount you can invest into the fund.
Yeah, and that's a wonderful benefit over the structure of your fund compared to the legislatively imposed restriction under 12J funds, where investors could only invest up to a certain threshold, either to avoid becoming connected persons or the rand amounts, the monetary amounts that were introduced. And these generalized tax provisions, they contain no such monetary threshold.
So another question here is there any, from an anonymous member, is there any chance that you don't get the deduction?
You don't get the deduction if you don't meet the requirements of the section. And the requirements of the section are quite clearly spelled out. That the monies must be used to invest in renewable energy assets from certain defined sources such as wind, solar, etc. They must be brought into use. So the moment you tick all of those boxes, then you must get the deduction. It's not a discretion on SARS on whether to grant it then, because then the Income Tax Act specifies the circumstances under which the deduction must be given. So the moment one has complied and ticked all those boxes, then it will, the deduction must. That's of course, sorry, Jeff, I see you about to, that's of course subject to the overall caveat that within any section of the Income Tax Act, there's always the part that gives the deduction, and then there's subject to certain requirements, limitations, deductions, exceptions, etc. So one just needs to look at the section in its entirety and make sure that that there's nothing that knocks one out. But I can't see anything that would knock an investor out of claiming the 12B or the 12BA deduction.
Okay, we have a question here from Mr. French. I'm retired and only do an assessment once a year. Can I invest for the year ended Feb 2024 before Feb 2024? And how do I know which assets are ready to come online at end Feb 2024? So if I can, so if maybe you want to answer the first part, Mansoor, and I will deal with the second part.
Yes, any expenditure incurred before Feb qualifies for deduction during this tax year, which ends Feb 2024. So yes, in fact, you should, if you want to have the reduction in this tax year, which ends Feb 2024, investments made in March 2024 will be for the next tax year.
So, and they say which assets are ready to come online at Feb 2024. So as every single month, as we are receiving investment funds, we are deploying them into projects. So we have the potential, or let's say the capability and capacity to invest in, say, 3 to 4 projects a month. So as we receive funds, those funds get deployed into as I said, micro partnerships. So those who invest during the course of August will then be part of the September partnership. And those monies will then be deployed towards certain projects. So if you only elect to invest in February, there's no guarantee that those funds will then be deployed timeously into energy generating assets by the 28th of February. So again, my suggestion is, if this is an investment that you feel comfortable with, which will generate 2 distributions a year, 18% IRR, then which is a high cash on cash yield of 14% per annum, then my recommendation is that you consider rather entering into this investment earlier rather than later. A question here from John is, all else being equal, would investment into the 12B fund, i.e. the partnership, trigger a requirement to register for provisional tax?
That's a very interesting question, because typically the requirement to register for provisional tax occurs where your taxable income from items such as interest or renting out fixed property, apartments and the like, foreign dividends, etc. And it exceeds, I think the threshold is 30,000 Rand. And if it exceeds 30,000 Rand, then you have to register as a provisional taxpayer. So I guess here the question would be, what is the nature of the income that the investors would receive from the partnership? What sort of income would flow through the partnership to the investor? And does that income fall within one of these categories that will then require a registration? And will it exceed whatever the threshold is, which I recall being about 30,000 Rand, but we just need to check if that's still the threshold. So then I guess the answer would be, in short, it depends on the nature of the distribution and the quantum.
So the distributions would be share of profits from the generated from the partnership, which is effectively a EPC, a energy, so the nature is share of profits, and then the quantum, you say, must be in excess of 30,000 Rand.
Yeah.
Okay, good. Okay, so documentation to receive from Grovest: you should receive a welcome pack once you've invested, and you should get quarterly reports on the investment and how your investment is doing. You should receive 2 distributions a year in September and March each year. Selwyn Smith asking, would batteries, inverters, generators, auxiliary equipment used for the running of PV panels be claimable under the 12B framework?
That's the last year somebody applied to SARS. I wasn't involved in the ruling application, such a pity, because it looked like quite a nice ruling. SARS has a process that allows taxpayers to apply to SARS for advanced tax rulings. And the reason for that is to allow taxpayers to work out the tax implications of a transaction before they get into it. And in December last year, SARS issued a ruling to the applicant in this matter. The published ruling is done on an anonymous basis, so they will simply refer to taxpayer A, which applied for the ruling. But the ruling itself is published, or at least a concise version, of a summarized version of that ruling. And that ruling concerned renewable energy project. And the SARS ruling that they gave was that the renewable energy assets in that ruling, which comprise the inverters, the batteries, the solar panels, the cables, which link them all together, they all qualified for the 12B deduction. So they took them all together. The rulings are typically based on the facts and circumstances of that particular application, because there was a debate before that ruling came out on whether SARS would regard the batteries and the inverters in the same light as the solar panels, Because when you look at the other incentive, the one we're not discussing today for the individual households, the tax rebate is only given for the panels, not for the batteries or the inverters, because the position there was that you can add inverters and batteries to your home and use the grid to power it up. It doesn't actually generate electricity from the renewable sources until you add the solar panels on. But the ruling that was given specifically under 12B, and it treated the whole package of assets as being deductible for 12B purposes. And that package of assets, it included the inverter, the battery, as well as the solar panels. So there is a confirmed ruling from SARS on that point.
So, guys, we're under a bit of time constraints. I'm going to try and answer a lot of these questions very, very quickly. What is the latest I'll be able to invest to ensure I get my full deduction this year of assessment? From Mr. Dioga. I suggest that the quicker you invest, you will get into one of the earlier micro partnerships, which would invest into the various projects. So those would be generating electricity before the end of the year. The expected returns, they are depending on when you are registered. Yes, that's correct, but we're looking at 18% IRR over the term of the investment, and with very, very high cash yield starting at 14% and growing over the period of the investment. Can I exit after 3 years, or do I have to hold on to the investment for a certain period of time? The way we've modeled the fund is it's a 10-year investment, but you're, unlike Section 12J, you are not beholden to hold it for 5 years to get the tax benefit. You can exit the investment at any time, but there will be a recoupment. In terms of the new tax rulings or that's come out in the TLAB, should you exit within the first 2 years, there will be a recoupment of the additional 25% if you exit within the first 2 years. Thereafter, you will be subject to a normal recoupment process, which is the value of the asset that is at the time of sale, up to the maximum of the cost of the asset, and thereafter, if you sold the asset above the cost, you'd be subject to capital gains tax. So I think that covers one or two of the answers. Mansoor is an impressive mind. Mansoor, that's a statement, not a question. So well done for that. Answer covered. The gross IRR, I think we've got that. It says from Daryl Moodley, how is capital gains calculated on 12B? On 12J, I know the base cost was set to 0. Is that the same for 12B? Mansoor, I'm going to set that over to you.
There is a general rule under the capital gains tax schedule that we are buying asset for which, we acquire an asset for which I've claimed an income tax deduction, then I'm required to reduce the base cost of that asset by the amount of the deduction which I've claimed. And we see it happening generally with assets that mimic air conditioners, anything that's subject to a wear and tear rate of period. As we claim that particular deduction, then the base cost of that asset gets reduced. So those are not peculiar 12J provisions, but they affected the base cost of the asset under 12J purposes, but they also affect all forms of allowance assets. The base cost reduction rule, again, like many other provisions, is subject to a few exceptions and requirements that one needs to work through. But the base cost reduction rule is something that is there, and the application of that to partnership structures must definitely be considered.
Okay, but as in simple terms, so it's not like 12J where your base cost came down to 0. Here, there's a recoupment of the accelerated depreciation up to the maximum of the cost.
Yeah, basically, yeah. But that part is, I mean, one needs to work through it very, very carefully.
Okay, Dion, as I understand, it's available for 2 years. 12B is, can you get the 12B after year 2, i.e. in year 3? Dion, I'd say at this point in time, 12Bs have been available since 2016. That's assuming that they don't cancel 12B like they did 12J. What is anticipated tax consequences at the end of the investment term, i.e. at the end of 10 years? At the end of 10 years, it is anticipated that the fund would sell the assets and its future cash flows because it enters into 20-year power purchase agreements with off-takers. And so one would calculate the future value of the future cash flows. So your recoupment, again, should be up to the amount of the cost of the goods that you of the invested or the assets invested into the project. Anything above the cost that's been recouped would be subject to capital gains tax. And then again, the minimum tranche is 100,000 Rand. But should you've invested 100,000 Rand, yes, you are entitled to do top-ups every single month in smaller tranches of less than 100,000 Rand. So you could invest 100,000 Rand in the first month, and then 20,000 the next month, and 10,000 in the following month, and nothing in the third. Yes, we are available to take on, do that type of investment, John. So guys, we are now, we've been, I'm conscious of time. It's 5:30. We've been here for an hour, and I'm going to just ask to put up a second poll before I do just some sort of close off. So would you like our team to contact you? Yes, no, to understand more further, we can have, I've got investment packs. We're happy to jump onto a Zoom call, happy to host you for cappuccino or cortado or espresso at our offices, should you so wish. And or happy to answer any emails or questions. Feel free to email me personally, jeff.m@grovest.co.za. Very happy to take your calls. Mansoor, I promised that to everybody that we wouldn't take longer than an hour, so because being conscious of time, so we are very, very, I just want to say thank you very, very much for your time, your comments, your wisdom, and for answering the questions and your presentation. As always, it's always a pleasure to work with you, and really it's greatly appreciated. I just take the opportunity to thank the marketing team, to Jenna and Terry for putting this together. Always professional, and it's a pleasure to work with you ladies, so thank you very much. And again, let me take the opportunity to thank the Grovest and the 12B team for the sterling job that they're doing with this 12B investment in the 10 years, and we've had it's our 10th year anniversary this year. Never have we received such amazing support and interest in a product that we've ever launched. And personally, I do believe this is probably the best product that we've launched. It's much lower risk. It's got higher cash-on-cash returns. You got guaranteed monthly cash flows. So thank you to the Grovest team as well. And of course, thank you to you, everyone who joined us today on the webinar. Thank you for joining us. Thank you for listening, and look forward to hosting you next time. Have a good evening.
Thank you. Thank you.